The end of 25 was huge. The most transactions like 3 years. And then already within the first quarter of 26, it looks like it's keeping up with what was happening at the end of 25.
I always say if you want to own the real estate, you should put in an offer and see where it goes from there. Because sometimes we're seeing deals that are trading 25% off list, sometimes 50% off list.
As a buyer, where am I winning?
Yeah.
Where's the focus? What's the playbook? And where am I winning? What's the target right now?
I think what I would be going after personally would be
So self-storage today is confusing a lot of people. Like, where are the deals? Everything seems expensive, but we're hearing about deals being done, and the markets seem to be so separated. But yet at the same time, we've hit the stabilization where we've seen occupancy and rents finally kind of level it out on average across the United States and even start to turn around. We've bought a bunch of deals in the last 6 months. You brought us that amazing deal that we got.
Yeah.
We love it. It's like we're so excited about that expansion play.
Yep.
And I think a lot of people right now, the first question I think we should hit on is they're looking at these deals online and they're like, that's so expensive. That's not a deal. And what I'm hearing from people is saying, where are you finding these deals?
Yeah.
So what is going on in the market with listing prices and what we see? And then more of a reality, how much is a difference there? What are things actually trading for right now?
Yeah.
Because that's changed a lot in the last 3 years.
It has. Yeah. And I think it's really being divided into two different markets right now. So you have the top 25, maybe top 50 MSAs, and that's where all of the REITs and the private equity money is targeting. And that is still keeping cap rates very, very low in that space. We're still seeing 5 caps, 5.5 caps due to their cost of capital. And then also due to a lot of their equity sources saying, hey, we don't want to gamble on a secondary or a tertiary market. We want to be in a market that we know makes sense, that has good household income, and then we can project rent growth over time. And hopefully we can also curb our oversaturation threats, right? Those primary MSAs, it's tough to build in them.
Yep.
It's tough to get stuff approved. So on that side, those cap rates are still very low and those premiums are still being paid because there's not a lot of that's in the market.
Yeah.
The mispricing, in my opinion, is happening with seeing a 5 cap trade and then trying to apply that to a secondary or a tertiary market. Those equity sources are not interested in those deals. So then that buyer pool becomes a lot less crowded than it was in 2021 and 2022 when the cost of capital was low. People were buying in those markets, right?
Yeah.
Now they're no longer buying in those markets. And on top of that, a lot of self-storage people have just gotten out of the business, right? They're like, hey,
a lot.
We were in it when it was good and we're not interested in being in it anymore. So in my opinion, I think the deals are still being had in the secondary and tertiary markets, but you need to work with your broker or your whatever that deal source is to create the deal. You need to be very open as to where you are, submit your offer. It might take a little bit of time. We talked about this week, but as a broker, I probably need 3 to 4 offers in this market to establish where the market is, right?
Yeah.
If I just get one, the seller's going to assume, all right, well, that's just one person, right?
Yep.
If it's 3 or 4, now we're kind of like, all right, this is where the market is. And over time, I think the seller starts to come to terms, but we're not seeing it in the headlines. I always say if you want to own the real estate, you should put in an offer and see where it goes from there. Because sometimes we're seeing deals that are trading 25% off list. We're seeing deals that are trading sometimes 50% off list.
Yep, absolutely.
And the more likely it's going to be a bigger difference, I think is directly tied to how small the market is.
Yeah. People are like, I'm not finding any deals. And I'm like, how many LOIs have you submitted? How many?
Yeah.
Well, none. There's been nothing that I want to put an offer in because it doesn't make sense. And I'm like, how do you know it doesn't make sense? Because that's the listing price, right? And that's not where the market's at. And like you said, it's interesting because there is confusion where the market's at. So the sellers aren't really there yet. But two, the sellers, the bid-ask spread, if you go back to 23, 24, that was massive.
Yes.
That was like a massive, but they weren't budging.
Yeah.
That was the thing. Like they weren't budging. But that seems to, the numbers we're seeing, The end of 25 was huge. The the most transactions like 3 years. And then already within the first quarter of 26, it looks like it's keeping up with what was happening at the end of 25 and even coming more. So the question is, are the buyers more coming to the table, or the sellers giving up more and coming back to reality that is making these transactions happen?
I think in most cases, it's the sellers coming closer to reality. I think we are starting to see some positive things on the operational side, but there hasn't been a lot of data leading up until the past couple months that would encourage buyers to be any more aggressive than they've been over the past couple of years. I would argue the longer the stagnant nature of occupancy continues, it's going to make buyers less and less aggressive, right? Because it's harder to see when things are going to change. So I think in some instances, buyers have actually gotten less aggressive. From the seller standpoint, I would say that in 2023, 2022, and 2021 were still in the rear view and not so far away. Now we're in 2026, and it's kind of ancient news at this point. It's been a lot more time for brokers and other people in the market to educate sellers really where the new values are. I also think that depending on how you structured the deal, if it's a mom and pop, it's not applicable to them. But if it's somebody that bought a deal in 2021 or 2022, they now have debt coming due in 2026 and 2027. So they have to do something. They could hold off in 2023, but now today. So that's really, there's a lot of people with terms coming due this year and next year, and it's forcing those sales, or, again, psychologically, it's forcing those sales in their head.
It's interesting too, because I think you brought up a good point. It was so close. It's really hard to swallow when you're like, I could have sold this at a 4 cap a year ago. Now it's like, we're in a different world, a different market. And two, on the seller side, and I think both the buyer side, it doesn't seem like there's anything that's going to change the environment anytime soon. I think there was a lot of hope that, interest rates are going to drop. Like the government's just going to drop interest rates. So I feel like that sentiment's gone now. Like we're not going to, in the next 6 months, have interest rates come down meaningful enough to where this price is going to radically change. So if I have a sell window that I wanted to sell in 23 or even 24, we're now into 26. I'm not waiting 2-3 years more. And then the rest of the population that can't.
I think people were under the impression that that was the new reality of the storage market and not a bubble that was kind of caused by COVID and the uniqueness of storage's place in the market during COVID, when you had a really low cost of capital and you only had a handful of places to put it safely, right? You had storage, you had industrial, you had medical office, and then everything else was more or less distressed to a certain degree. So I think now that we've seen the data come back a couple years later, we're like, all right, that was a little bit of a bubble. That wasn't the new reality of storage. And now we're adjusting kind of to that new reality. So I think, again, to your point, it was still very fresh in the rear view mirror, and any seller that could was going to hold off, which is why we saw such a low transaction volume occur in 2023. It was that seller psychology saying, well, I can't sell it for this much.
Now, you mentioned distress. I already think we are now 5 months into 26. My rear view mirror, I'm looking back, and based upon our deals, the numbers and what done, and you saw some of the numbers, things have been going through. I want to show more. We're at our Inner Circle event here in Boise, Idaho. We're going over stuff. So I think 2025 is going to mark the time that I got the best deals that I'll probably get through this cycle because of the distress, right? You saw how far below replacement cost we were picking up deals at $80 a square foot, brand new 4-story, climate controlled, $170 rental asking prices in the market that would cost me $150 to replace, right? Like I haven't seen those anything close to that since like 2010, 11. Are we going to continue seeing distress like that Because even when I'm looking at the numbers, what did you see? But it seems like a lot of larger players were the ones, and people that were storage people were in it. We see it, we know. They were picking up distress in that end of 2025. Or by distress, I mean people that had to make a selling decision. Refinance, a lot of developments that came online, need to get rid of. Are we going to continue seeing some, and by distress, once again, I mean people that are forced into a buying decision, so they have to concede with much lower prices? Are we going to keep seeing that, or is that something that you think's kind of gone away? Things will be at a discount still.
Yeah.
We're still going to be getting these great prices. Sellers aren't going to get what they ask, but that kind of steep discount, do you think we're going to be seeing that in 26 or 27?
I actually think without interest rate relief, that we'll probably see more distress over the short term, over the next 6 to 9 months. And the reason for that is I think most people feel like you take a survey out of 100 storage buyers, they feel like there's a lot of inventory on the market right now, and probably not a lot that numerically makes sense, right? Maybe stuff they want to own, but like we just talked about, hey, it doesn't underwrite, it doesn't pencil. I think if you're on the market right now, it means that you do have something coming up, right? Because again, unless you're selling something in a top 25 MSA that's stabilized, outside of that, it's probably not the best time to sell. So if you are on the market, there is a reason you're doing it. There could always be, outside life reasons, but I think as we get closer to that debt cycle in 2027, we're going to see more and more inventory hit the market. I think it's this summer especially, and that'll create a even greater buyer's market. The other thing we haven't really seen in storage yet is we haven't seen a lot of banks take back properties.
Yeah, they were holding off. They were pushing it out, right? It was people were working with them and people were pushing it out. You didn't see banks really jump in, cut them off, say, hey, we're moving in here. It seems like they were punting.
Right. They've been, and I totally agree. I think that's what we've seen. The banks have punted, and I've kind of chalked it up to, well, they're not as familiar with this asset class like they are with multifamily. Maybe they don't want a ton of storage on their own books. I think that's coming to a head, especially with a lot of these non-performing assets. New development and oversaturated markets, stalled out lease-up deals. So I think we're going to see more and more of that, and I think we've already started to see banks take a little bit more action and force people to sell at losses. On top of that, investors don't want to double down on these deals, right? They're doing capital calls. They're saying, hey, we need more money to, for operating reserves, whatever it might be. People are saying no. So then they're forced into a sale. So again, I think it's a lot of psychology that's driving sales nowadays. Maybe it's not an imminent foreclosure, but it's something like, hey, this could happen over the next 6 months. And for that reason, I think we'll see more inventory hit the market. I think we'll see more of a buyer's market between now and the next 9 to 12 months, sometime around then. And I think it'll get better. Now, with operations improving, that might allow buyers to get a little bit more aggressive and feel better about their portfolios and feel better about paying a little bit more. So I think that's where, that could be one redeeming quality for sellers in this market.
Hey, podcast listeners, as you know, self-storage, we give away all our information for free. It's my open playbook, and I share with you guys every single week what we're seeing and what we're doing. But what a lot of people don't know is that we have even more resources available. So you may not know, but I wrote a book that's hard to even call this a book. I mean, this is a manual. We're talking 400 plus pages, which include all sorts of information about how we have been in the self-storage industry. That's everything from how we got our first deals, to scaling, to buying deals in today's market, what's changed and what remains the same. This is an up-to-date book that shows you how the market has changed and how you can win today. This isn't simple, this is how you buy a deal. No, this goes into everything, including how you scale and create a self-storage business. You can get a physical copy, an ebook, or the audiobook, plus free access to bonus content at the end of each chapter. You can get it today. It's available on Amazon and other platforms in which you can follow the link.
From our experience and what we're doing right now, to be open, our pipeline is 85% Texas and Florida. The deals that we have bought, as we bought some in Iowa, North Carolina, but the biggest ones, Texas, under contract, in Florida. And these are all deals. So out of them, 50% of them are fill up. The other ones are not, but they are buyers that they're stuck, or it obviously seems like they need to let go of the asset. The one that we purchased with you, I was doing the numbers. I think it was 30% under asking that we actually got it. We have our deal that the seller's financing. He's doing seller financing, $5 million deal, $4 million. He's carrying the note at 4%, interest only for 5 years with extensions.
Wow.
And he's 60% full because it was a brand new asset. Crazy.
Yeah.
And under market rents. So, out of some of these deals, we're seeing them, even the seller, coming to the table saying, we'll do things to make this work. Right?
Yeah.
And that has been so largely focused on the Texas, the Sunbelt markets, right? At least from where we're seeing it. We are buying others, but once again, right now our pipeline is 80%. When I say pipeline, I'm talking about deals that we actually are in submitting LOIs.
Yeah.
Not deals we're looking at.
Just looking,
like actual deals that we're working on, we're submitted or submitting the LOIs on. That represents, I think, 10 deals right now out of everything that we've looked at in this current moment. 80%, 8 of them, Texas, Florida. Do you think that that's going to continue in those markets?
Yeah, I think so. I mean, that's where we saw so much of the population growth occur over the past 5 years. I think that's why we saw so much development occur in those markets. Some of those trade areas in those markets have recovered a lot quicker, right?
Yes.
We've seen rents come back quite a bit.
Yep.
Some of them have not, right? And those are, in my opinion, the most distressed assets right now. When you look at a market in Florida where you have 30 square feet per capita, and there's another 2 developments coming in because they were already building there. So I think a lot of those people are going to be forced to sell. So we'll continue to see a lot of opportunities in those markets. But I also think that the buyer pool recognizes, and a lot of buyers recognize, the fundamentals of a Florida or a Texas as incredibly strong.
Yep.
They look at the market, they say, hey, we're working on a deal in Fort Pierce right now. It's a 6.7% annual population growth, right?
Yeah.
That flies off the page right off the bat, right? Especially with now what's happening in New York and some of these other states, more and more people are coming to
We'll edit
Florida.
that out because we're buying it. I'm just kidding. Right? Yeah.
I know. I was like, I shouldn't say it.
No. That's what I want to hear. Yeah, exactly.
No, and then you look at, this is something we've talked about over the past couple of days, but you look at the average household income, and there's enough income there to support aggressive rent growth over time. And that's one of the biggest mistakes we saw buyers make during 2021 and 2022 or 2020, was looking at the rents and saying, oh, we're getting $200 for a 10 by 10 climate control. But the average household income in the area was $50,000. It didn't line up. It didn't make any sense. And when you look at that now, I think the markets that make the most sense in terms of population growth and in-place average household income and future residential developments are Florida and or Texas.
Yeah, that thesis tends to remain strong. And it's important, like, we went through this in 2008, and that was our thesis because second-tier, fast-growing markets were slammed.
Yeah.
Like, right, deep discounts. But when we look at when we were analyzing the income, the population growth, the migratory trends, we're like, these aren't short-term trends, right? These aren't, it's not like it's interest rates that are, okay, this is a market function that changes a lot. These are sustained, continued.
Yeah.
And so we moved into those second-tier markets we took advantage of those, and it was the wealth creation that came out of that was mind-blowing to me. But two, also, that wasn't universal. People are like, oh, that was anything in 2008.
Yeah.
No, it wasn't, because I bought other deals after 2008 that did not see, of course, prices went up. Yes,
Yeah.
but not like we saw in those markets. We've really, for the last, I'd say 6-7 years, we wanted to be in Florida and Texas.
Mm-hmm.
We just couldn't make it work.
Yeah.
Whereas today now, I wouldn't be surprised if we end up in 2 years and half the portfolio, because we're buying so much, ends up in those markets.
Yeah.
So it provides a really good opportunity for buyers to get in incredible markets in a time when it's hot, when money's cheap. Those markets are expensive.
Yeah.
People are paying for that growth. You're paying for the growth that's happening in 3 years, right?
Yeah.
What do sellers need to do, though, when you're looking at a deal that you've got the last 3 years?
Yeah.
And the last 3 years was occupancy's down.
Yeah.
Rents are down. The last 6 months, we've seen a change, right? You saw my numbers,
Yep.
and we showed what has happened in the last 6 months across our portfolio. Occupancy, rents, how much it's changed and gone up, really strong during the slow season. Are people looking at this change as a real change over the last 4 years? Or are people that, no, okay, the market has stabilized?
Yeah.
Or are people really, really nervous still that there's more softness in the market and it may not be sustainable, that we really haven't hit the floor?
Yeah.
What are you hearing? What are you feeling?
I don't think that it's universally been accepted that we've all turned the corner. I think it's market by market. I think if you talk to, one operator, it could, you could be, hey, this is great. If you talk to an operator that it's in a pretty oversupplied market still, they're probably not seeing that, right? I spoke with one of my clients last week, and they're like, how do we go down 10 occupancy percentage points over the past 6 months? So it's not occurring, across the board.
Yes.
And I think we really need to have a strong leasing season, this summer.
Yes.
In most markets for buyers to say, all right, I feel actually better about the macro storage market now. And
Because last year it started off strong early in the spring, and then it went away.
Everybody got very excited.
Yeah, everybody was very excited.
We all started pricing things a little bit more aggressively.
And it was gone within 3 months.
Yeah. So I think it's still too early for people to say, all right, great. And on the residential side, which a lot of people have tied people moving to, occupancy and rent growth over the past couple of years, we really haven't seen that pick up much on a macro level either. So I think that will need to pick up. And again, if we see relief in the interest rates, that would be great. I think everything will start to, come around, but
who knows?
We'll see. Yeah, we'll see.
So now, if I am wanting to take advantage of this moment in time in this real estate cycle, where obviously we're not seeing things drop like they were over the last 4 years, things like that, where like a softening, it may come down a little more, it may get in. What are the factors that I need? Because I completely agree with you. Remember, everybody, self-storage is a 5-mile game. Market dependent, not just market dependent, even bigger markets. It's like, what part of the city are you in? So when I'm looking at deals, what are the things that I need to be looking for in that market to know if we're going to have more problems, or if at least things won't, like we're not going to see further occupancy drop? Like, what are the drivers and what are the red flags that you're looking for?
Yeah. I think first and foremost, and this has always been important, but it's probably the most important thing to a REIT or a private equity group or an individual. It's across the board, right? I could be selling $1 million deal. I could be selling a $15 million deal. Having another development in the market coming online or having oversaturation in the market, I think is a non-starter nowadays.
Yeah.
It is just, it's almost impossible to sidestep that, because not only does it create occupancy issues, but it also creates, all right, what are our rents going to be over the next 4 to 5 years? It makes that basically that equation almost impossible. So that is really the biggest thing. We touched on the average household income. I think that's become critically important. I think one of the really tough things to work on right now is if you see a stalled lease up deal that's a mom and pop owned deal. We talked about the new development in Des Moines, right? If that's a mom and pop deal, or even Lulu's in York, that was mom and pop owned. You're like, all right, is this an operator problem or is this a market problem, right? I thought that was a great point. That's really what you got to look at. And it's really tough to sell a larger syndicator or a group as this is an operator problem. It's probably not. It's probably a market problem at that point. So I think that is one of the biggest things to look at, right? Can I actually achieve this business plan? Am I any better? Realistic, honestly, look at yourself and say, am I any better than the guy that's already tried to do this? I think the other part of it, and this is a really tough one, but do I feel like the market is going to get any better over the next 5 to 7 years? I think some buyers are taking the opinion that like, hey, things are going to remain the same over the next 5 to 7 years. I think that's a little bit too pessimistic of an outlook, right? If you don't think things are going to get any better at all, or you can't improve this asset at all, you might want to be looking at other asset classes right now, because that's a long time.
That's
right?
a
The next
long time.
5 to 7 years is a long time.
Combined with what we've already seen.
Right.
I mean, that would be, we didn't see that in 2008. That long. Like, not even close.
Yeah.
So that is very pessimistic. I could see it on an individual market level. Like, I mean, like in a 5 mile radius where you go, there's so much new supply and we have vacancy based upon its population growth. Yeah, it could take 5 years for things to not just fill up, but to return. Yeah, that makes sense. But overall, are things going to get better over the next 5 years? Take. And to even show the example, you know, we bought those 2 facilities. We closed. Our first full month was in December, and by March they were right around 30% occupied, institutional grade, everything. By March, we'd increased revenue by 50%.
Yeah.
In 4 months in the slow season.
Yeah.
So that really goes to show that difference in operator. But if the market doesn't support it, it doesn't matter how good of an operator you are.
Right.
You can't win against that.
Yeah. And I think one of the things, you know, we were talking about that 5 to 7 year timeline. Some of the deals that worry me the most are deals that were built in really small markets. That are now maybe overbuilt in perpetuity, right?
I could not agree more. I saw a deal 3 months ago. I actually was presenting to our community because somebody asked about buying it. It was 50% occupied. It was this small market. There was one other competitor. And I rarely, every time I look at a deal, I go, what does it take to make this a deal? At some point, I'm like, no, I'll buy it, right? At some level, I'll buy it.
Right.
You can give it to me free, I'll buy it. This deal, though, at 50%, it was negative because the property tax, it was in Kansas.
Yeah.
The property taxes were so big, it was bleeding money. The market was small. There's no growth, anything else. And I could not say whether they could even fill up.
Right.
Like, I don't know that you can even get to 80%, 90%. And definitely raising rates, no, but that I wouldn't have even if they gave it to me, I wouldn't take it because it could still just bleed money forever. The property taxes, the insurance, the expenses, it would have to stabilize and probably up rates to get it to do it. But in that market, I was like, there's a real possibility that it doesn't happen.
This is
how it
forever.
is.
Yeah.
Like, because where's that demand coming from?
Yeah. In my opinion, those are the deals that worry me the most, or deals you see like that. And again, those were more than likely local developers. You wouldn't see somebody from New York jump in and say, hey, I'm going to build in Kansas, but somebody that got the idea in their head, storage is a really good model. This is where I live. I'm going to build here. But there really just weren't enough people in that town. And I think what's interesting too is, I'll tie that to something we were talking about earlier, right? When people start moving again, I think the assumption is that, you know, interest rates come down, people start moving again, and we're going to get an occupancy push. Well, it's not going to happen in every market
No.
equally across the board.
Absolutely not.
It's going to happen probably in the markets that people really want to move to or
Yes.
have wanted to move to over the past couple of years. And those smaller markets, I think we could actually see more people leave. Those markets.
Yep. Now they're
'cause they've been
freed
rate
up.
locked. Exactly. So I think like if you're waiting on interest rates to get lower in a true tertiary market for your occupancy to go up, again, this isn't across the board, but
No.
I've seen a fair amount
You
of
got to be aware
examples
of
like
those
that.
ones that have those dangers.
Right.
And that's the thing in a market like today. For me, I look at it, I'm like, there's more opportunity that I've seen in, over a decade. I'm so excited about it. But two, you have to remember why there's opportunity.
Right.
Because there is uncertainty and there is risk. And when you look at the opportunity, I always go back down. We don't find deals, we make deals, right? Like when you come to us with a deal, first thing you say, hey, this is what the seller wants, but you say, what do you need to make it work?
Right.
And get that LOI in. And then we work together on figuring out what that point is, right? Where it is that this deal becomes a deal. And then we go in and you make it work. And that can be in terms, price, it depends on the strategy or doing an expansion. Is this just a mom and pop turnaround or is this just a great asset? We have a guy today, it's crazy. He signed his deal, right? That you brought him.
Yeah.
He was talking about that. He signed it $500,000 and he's like, there's no real big upside on it. And that's fine. He didn't want upside. It was a solid deal.
Yeah.
It was remote managed. It cash flowed. There was upside, meaning, there'll be growth and everything, but it's not like this is a turnaround asset. There's just tons of meat on the bone. But he's like, I didn't want that.
Right.
And it was a smaller market and it was an awesome deal. He's so excited about it. And so there's different strategies that you have to deploy, but that's a very different way that you look at an asset than a fill-up facility.
Yeah.
That you need population growth, you need rent bumps, and you need future things to happen to make that work out, right?
Yeah.
So it's a really exciting time because of those opportunities, but it's also a time where you got to do your homework.
Yeah.
And I think the new supply part that you hit on right there at the first, when we were talking about this, that is hands down the number one question. Like it is, that makes or breaks deals today. And that is the number one thing you need to watch out for.
Yeah.
Is not just new supply that's on the market today, but new supply that may be coming onto the market. Which brings me to my next question. Supply, the development cycle.
Yeah.
Putting out new deals. We went through a time where the amount of deals, what were the numbers? How much did development go from kind of that height to in the last few years? How much did that change?
As far as a drop off in percentage?
Yeah, like supply.
Yeah.
Do you know off the top of your head?
I would guess at least over 50%. But
Yeah.
I don't know off the top of my head, like how many.
Yeah.
I mean, what's happening, what's interesting is there is still a lot of development happening with the REITs.
Yeah.
So, you would say, all right, well, it doesn't make as much sense now. There's still a lot of big REITs that are building a lot.
U-Haul?
Right now. U-Haul, Public.
Holy cow. Yeah.
They're building a lot of, they have a lot in the pipeline, but they're also building massive facilities, right?
Massive
U-Haul builds
bombers.
huge facilities. So, normally I was, all right, yeah, I think it probably dropped off quite a bit, but I actually think it hasn't dropped off as much as you would expect because a lot of people have gone and backfilled from that public sector, right?
Yeah.
And they backfilled the pipeline.
Now, from what I'm seeing is it's very focused, meaning you're in first tier and high growth markets where that development's happening that have larger incomes primarily.
Mostly. But there are some developments that are occurring in some smaller markets right now or, in between markets. It's more so strategically map focused. And again, U-Haul is a different model with the truck rentals and everything. But, Public is filling in some gaps that they've wanted to own in for a while. And it's not just Chicago and New York and LA. It's emerging markets in Florida.
Are they filling in due to, like you mentioned the map? When you say that, are you talking like their management Like, oh, we've got stores here, so we want to fill in a location there.
Yeah, I think it's more so, filling in like, all right, we want a greater presence in this particular market. We've tried to buy here for a while. We're just going to build instead, right? There's certain markets that they really like, and they're saying, all right, we're going to jump into this market. We're going to build. And again, I think that's dangerous for the individual owner operator, the individual developer, because it might not make sense on paper. And you might say, hey, who would ever build in this market right now?
Yeah.
They have a different operating structure. They have a different cost of capital.
Yep.
They have staying power forever, right? At the end of the day, if you have staying power, you can stay in the game forever.
We
and
can bleed.
They can outlast you.
Yeah, it doesn't matter. Now, you mentioned the REITs. Outside of the REITs are the biggest players. Like if you're in a market where it's maybe some small regional players or mom and pops, are you seeing, has it gone down development from REITs and the biggest players? How does the development look in those more small second, third tier markets with non-REIT players? What about that segment of the market?
I think it's definitely slowed down, but it is interesting because as the acquisition issues we've had have become so challenging, there have been a whole group of people that said, well, why don't I just build instead?
Because I don't have the option to acquire.
I can't acquire right now because I don't want to pay a 5 cap or a 4.5 cap. I'm at a 7, right? This bid-ask spread has been going on for 3 years.
Yeah.
So yes, there's less of it, but because of that challenge, there's more than maybe you would assume there would be, because a lot of people are just saying, hey, I'm going to build. I need to keep putting money out. Right? Like I can't just sit here for 3 years and do nothing. I need to either put money out on the development side, I need to put money out on the acquisition side. So we are still seeing a lot of new development in Sunbelt markets. I'm curious to see how the market absorbs that over the next couple of years. Because I think, there's this thesis out there, there's this like myth out there that nobody's building right now. And that, again, maybe it doesn't.
I opened up 2 facilities last year. I'm building another one.
Right.
Yeah.
Right. So it is occurring, and I'm curious to see how the market absorbs it. But again, I think that most of these developments are happening in markets where there's at least major population growth.
Yes.
Good income. The tertiary markets, we're not really seeing any developments. There.
Yeah. And that has a lot too, because one of the problems with developments, the costs really haven't come down.
Right.
So you have occupancy and rates that in some markets have tanked. And maybe not so much the occupancy, but the rates, right? The street, your asking price, which the street rates when you're in a development are what's important because you don't have that basis. So what that street rate is coming in, that's what you're getting.
Yeah.
So when you have the cost to develop and it has not come down that much, so it's expensive to develop, but then you have markets where you have rental rates at, 70 cents a square foot.
Yeah.
That math doesn't math.
Yeah. No, it doesn't work. And there's another thing that's happened over the past couple of years that didn't exist when I got into storage and didn't exist. Well, it existed. And basically I'm talking about the real estate tax bill.
Oh, yeah.
We got away with really low tax bills for a long period of time.
Yeah.
When I got into storage, a lot of municipalities were like, oh, we use Marshall and Swift value for mini warehouses, which was $25 a foot, $30 a foot or something like that. I know, some markets had even lower. Now those municipalities have caught all the way up, right? That coupled with insurance issues in some coastal markets, coupled with rents tumbling down. Yeah, I mean, it doesn't work out on a spreadsheet in most instances. But I think some of the people that are doing it right now are looking at longer investment horizons.
Yes.
They're saying, hey, this isn't certainly not a merchant build. We're certainly not flipping it at CO.
Yeah, that from what I've seen is gone.
I think that's gone. Yeah, I think that's gone for the most part. I think there are rare instances where, hey, this isn't a primary market and we can still make money, but it's very, very tight. I think they're looking at some of these deals for 7 years minimum. If not, it's a 10-year hold, and we're going to wait until the market bounces back, and we're going to wait till we get through all of this oversupply.
You bring up a couple interesting things, especially on the expense side. Washington State, I don't know if you heard this, they have a self-storage tax. They actually targeted self-storage, and they added on taxes just to storage.
Interesting.
So we have seen the way governments look at storage has changed dramatically since COVID. Before, nobody knew, nobody cared. It's just overlooked. Regulation, overlooked.
Yeah.
We now have Extra Space, who's in a lawsuit with New York, and I think one other. This is popping up. So how is regulation affecting now the outlook from buyers?
Yeah. Again, I haven't heard people directly correlate, hey, this particular lawsuit or this particular issue is making us not as excited about the asset class.
Yes.
But I do think if we're starting to read, between the lines and going back to that, that real estate tax example, we got away with flying under the radar for such a long period of time. And I don't think we'll ever go back to the construction costs we saw back then, to the tax or the expense loads. We got away with that for a long period of time.
Yeah.
So when you look at people that have been in storage for a really long period of time, one of two things are going to happen. They're going to look at it and say, okay, this is the new reality. And it's kind of what you're doing. You're saying, hey, this is the new reality. I'm going to continue to evolve and change and understand the asset class. Or we're going to have people say, all right, great. Like, that was nice to be in storage during that time period. I'm now going to go into something else now.
Yeah.
And we've seen over the past couple years, it's been kind of like a split between people.
Yes.
A lot of people have said, all right, I'm going to double down and figure out how to operate in storage in this new landscape. A lot of the other people have said, hey, I'm going to go and do flex warehouse. I'm going to go into medical office. I'm going to go with something else, right? I'm going to go into a different asset class because the opportunities are no longer there that were there in storage when I initially got in.
Yeah. Most of that too I found is mostly large groups that are focused, to lots of them, on primary markets. I've heard that from groups out of, California on the development side with worries about regulation, the tax, New York, definitely Washington in the last 6 months. That's been an ongoing thing until they're like, we're done with self-storage in the state. It's interesting to me how self-storage is split, because what I hear from large groups, primary market based, is very different from what I'm seeing and hearing from people that play in third tier markets are mid-sized. They're not groups that need to deploy $200 million in capital.
Right.
And for them, they're excited. They're buying because they're like, I can get cap rates are up.
Yeah.
I can get great deals. I can go into these markets where all these institutional players and everybody don't play. There's mom and pops, because in these big markets where you have to deploy this large capital, where you have now regulation concerns, tax concerns, right? And you need to deploy all that money, right? That's created some relook because the mom and pop doesn't exist there anymore.
Yeah.
You don't get that operational upside.
Yeah.
So for mid-size and smaller, and when you're moving into second tier, but then third and fourth tier markets, for me, it seems like it's a totally different story. Like there's kind of been a split in the way they see or find, because those issues tend to not be hitting them. Like if I'm in that first tier market, I'm still paying a 5 cap.
Yeah.
Insurance had doubled. Taxes have doubled.
Yeah.
I'm worried about regulation. Interest rates have gone up and I'm at a 5 cap. It's very different when I'm not dealing with those problems. I don't have an oversupplied market and I'm ending up paying an 8 cap.
Yeah. That's really, in my opinion, where the opportunity is for the individual, for the more nimble group. I mean, one of the things that, we've gotten feedback from this in the field is it takes a long time. If you're an operator, but you're partnered with a major equity source, it takes a long time to be able to switch your business plan, right? You can't dynamically go back to that major equity source and say, hey, I know I sold you on primary markets in April, but now we're going to secondary markets or tertiary markets 2 months later. They're going to be like, what are you talking about? This is a 180. Also, our firm doesn't invest in tertiary markets, right?
Yeah.
So I think what you're hitting on is, I think cap rates are synthetically low in those markets right now based on where interest rates are, because there's so much competition going after the same thing, right? So as an individual or a more, smaller group, nimble group, I'm going to say, all right, I'm staying completely away from those markets for that reason and all those other reasons you just listed. I'm going to go after the secondary markets where there's less likely to be regulation, where I know I'm probably going to be competing against other individuals with the same cost of capital as me.
Yep.
Where there's more likely to be mom and pops, because going back to like the playbook, that's really always been something that's worked out.
Yep.
And I'll tell you, when we get mom and pop deals, those still fly very quickly because
people
they are
want 'em.
harder to find in today's market.
Yes.
And the reason they're harder to find in today's market is because a lot of brokers are being handed inventory from not mom and pop people. They're being handed inventory from syndicators that bought 3 or 4 years ago.
Yep.
They're being handed inventory from people that tried to establish, a business plan and it didn't work out. And they're saying, hey, I want to get rid of this. When you're being handed inventory, it's less time for you to then canvas for mom and pop opportunities.
Yeah.
And that's why I think there's so much of that on the market right now, and there's less mom and pops. But when you get a mom and pop, it flies. That's what people want. That's kind of the value add that's still there and still really achievable.
It's wild to me how many people that jumped into storage are gone now.
Yeah.
Like how many syndicators, everything else, they got burned, they lost their deals, they either went to other assets or they got out. We look at our cost of acquisition and the time that it took, everything from investors and, working with this, and it has just cratered as far as the cost, the need, everything else, because the pool is just evaporated. It's like gone. There's just so many less options. And then those deals they're flooding the market.
Yeah.
Right? Where it's like, hey, we need out. We did this, but then the mom and pops are being overlooked. These deals are coming out. They're not as, I think, a lot of times attractive deals.
Yeah.
And the market can get a little saturated with that. That's why we're combing through so much.
Yeah.
We're like, once again, the deals and opportunity front are amazing right now. We have to go through a lot of deals to find them. Like, it's not easy. We got to go through work to find them because of all those deals that have just kind of come out to the market that they're just offloading.
Yeah.
And I think that'll continue for a bit.
I think it will. And that's kind of why I think we're going to go more into a buyer's market because, again, a lot of those people, those are the deals that have debt coming due next year or this year, right? It's not the mom and pop seller. They paid off their property 30 years ago or whatever it might be, right? Those are the deals that have real pressure to sell. So we're going to see more and more of that inventory come up, between now and the next couple of years. So I don't know, but I do think, at the end of the day, that is what's flooding the market. And right now, finding a good mom and pop deal, that takes the extra time. That takes more diligence on the broker side to say, hey, I really can't do anything for you right now.
Yeah.
My method, if I were in acquisitions right now, and I think something we're starting to see is I think buyers use an initial LOI to see who's willing to budge, right? So you're combing through, hey, I'm combing through hundreds of deals. One way to see, all right, will these people move? I'm going to submit an LOI.
Yes.
And from our side as brokers, what we've now conditioned our clients to do is say, all right, listen, if you're getting an LOI, to show that you're motivated to actually sell, you need to counter very quickly and you need to come off that list price very quickly if you're ready to actually move. Because if not, these people are going to move on very quickly.
Yes.
It's not hey, I'm super interested in this deal. It's I could be interested in this deal if you're willing to move off your price.
Yes. And transactions are up. Like the last 6 months, I was looking at the data stuff and they're up pretty substantially from what they've come. What does that landscape look like? Deals that are actually being sold now, the last 6 months, let's say mid 25 on, or you could take full 25. But for me, from the data, it looks like really mid 25 and, last part, third and fourth quarter of 25.
Yeah, we picked up.
Comparative to 24 and 23. How's that change been?
When you look over the past couple of years, right off the bat, the interest rate jump was just too severe. So you had people really slow down. Now I think we're starting to see major And again, I think it's more so due to sellers because they understand that there's pressure coming, but we're starting to see a major pickup in the market. I think we're projected, we went from something north of 20 during the heydays, 20 billion in transaction volume. During the slowest time, I think it was around 2, and now we're projected around 5, right, this year. And last year was about 5. So it's supposed to continue in that direction. Again, it's really going to depend on what hits the market. And then also a lot of this transaction volume is, when you're talking massive numbers, it's spurred with those bigger portfolio plays. Some of them are happening on the market, some of them are happening off the market. You have consolidation continuing to occur. I think that will continue to occur in the strategic markets where it makes sense. So I do think, from a consolidation standpoint, that's going to contribute to that sales volume going higher and higher up as these firms continue to be acquired.
So last question for you here.
Yep.
You're in today's market. You're seeing deals, obviously, every day. You got tons. We work with you on deals. You guys are, your firm, dude, you get a lot of deals. You guys are, I'm like really surprised by it. Like it's amazing. Like as a buyer, where am I winning? Yeah. Where's the focus? What's the playbook, and where am I winning to find deals? What's the target right now?
Yeah. I think if you're focused on what's hitting the market, right, which there's a lot of volume on the market, I think what I would be going after personally would be lease-up deals in secondary markets. I would love to be, I still like the Southeast, but I like the Sun Belt in general. And the reason for that is I think that's where you're going to see the most opportunity realized over the next, call it 7 years. Again, I would structure my capital a little bit longer. I would have a longer timeline, but I would be looking for deals that I'm buying below replacement cost or close to, newer assets. Maybe they're a little oversaturated. Ideally, you don't want to be in a market that has extra space on every corner, and you don't want to be in a 30 square foot per capita market.
Yeah.
But being in a market that's a little oversaturated right now is where you're going to get the discounts, right? If you're in a market that's 3 square foot per capita, you're not going to get a discount. Everybody's going to want that deal. And now all of a sudden we're back in those red waters where everybody is competing for the same thing. So I would be looking at markets, secondary markets in the Southeast. I look at Knoxville, like that's a great market that long-term, I love the fundamentals, but in most trade areas, it's overbuilt right now. And I think over the next 5 to 7 years, we're going to see that market bounce back. We're going to see continued rent growth, but we're also not going to see a ton of new development over there either because it doesn't make sense. Right.
Yeah.
So I think getting those deals, again, you're buying new product. You're not buying a 40, 50-year-old asset at a 5 cap. You're buying new product. There's going to be limited CapEx. You're going to be happy you bought it. I mean, that's where I think those opportunities are right now. I just think you need to toe the line between paying up too much for an asset that has a very low square foot per capita or paying for an asset that has a 30 square foot per capita and may never recover.
Yes.
And knowing where that is, I think, again, we look at a lot of deals. We see when it's like, hey, that's it. But ask your brokers, ask the people like, hey, do you like where this could potentially go over the next 10 years, or is this just kind of oversaturated? And have, trusted, if it's not the broker on the deal, have other brokers or trusted advisors in the space that are seeing a lot of deal volume. I think, you mentioned the volume that we're working at. I think the most valuable part of that is we have so much real-time data that we can then apply to the market and apply to our pricing. Like having that deal volume is incredibly important for us because we can say, all right, we priced that deal right. We're going to price this one the same way. Or we price that deal horribly, which happens sometimes. We make mistakes. We're going to change accordingly. But if you don't have volume, you don't have that data, and therefore you don't really know what's going on in the market. I think this is the most dynamic market we've seen. It's moving not year to year anymore. It's like month to month, week to week. It's like, hey, how was your occupancy this week, right?
Yeah.
People want to know about it. It's because we've had so many challenges. When things are good, everybody's like, all right, we're in a good market. Yeah. So having that data right now, I think is extremely important, and knowing what to buy. I would rely on as many people in the industry that you truly trust and, are giving you good advice. I would rely on all those people to back check deals for you. Hey, what am I missing here? What don't you like about this?
What about the beginner that doesn't want to do a lease up because they've never done it before.
Yeah. So going back to those kind of like that, the discussion about high risk, high reward, and that deal, Jason just bought 500,000,
Yeah.
For beginners, I would usually steer them in this market towards something that's already physically stabilized. And you're getting, I think for the first time purchase, it is, in my opinion, a true buyer's market. You should be getting a good in-place yield day one.
Yes.
You should be getting a good basis day one. I think you should be getting both, ideally, but compared to the market, right?
Yeah.
And we talked about this yesterday, right? $80 a square foot might be excellent in Florida, and it might be terrible in Kansas, right? Yeah. So understanding what a good basis is in each individual market is also very helpful. Again, lean on your broker, lean on the comps. But I think this is the market where if you're a first-time buyer, you should be getting both a solid yield day one, and you should be getting a really good basis and an opportunity for appreciation. But to use a baseball term, like that should be a single/double.
Yeah.
Not like, hey, we're swinging for the fences and we're going to hit a home run.
Couldn't agree more.
Yeah.
And it's unique that you could be in a market and actually get that. A good basis and a good yield.
It's been a long time.
Long time, dude. Long time since we've seen that.
Yeah.
So, well, man, hey, appreciate you coming on.
Yeah, thanks for having me.
So much happened. People are like trying to get their pulse on the market. So we really appreciate having somebody that actually has their pulse on the market, seeing deals. And where can people get a hold of you? Where should we send them?
So Frank DeSalvo, frank.desalvo at franklinstreet.com. Put contact information. I'm on Instagram, Frank Vincent DeSalvo. On LinkedIn, connect with me there. Always happy to talk storage.
Perfect. Those will be down in the description. Thanks, everybody.
Awesome.